S&P 500, it started the year in 2023 at 3,800 and ended the year at 4,007. Then in the next year in 2024, it ended the year at 5,900. Each year, it clocked more than 20% of gains. So the big question, after 2 consecutive years of big gains for S&P 500, what lies ahead? Today's video, let's answer that. Hi guys, welcome back. Today we're looking into history to tell us what would happen to S&P 500 after 2 consecutive big gain years. This is actually very rare, almost once every 30 years or so. The first data point is in 1935-1936. These two were big gain years, but then in 1937 there was a big crash. The next time S&P 500 had a big back-to-back 20+% gain was in 1954 and 1955. Then in 1956, there was still a small gain. In 1957, there was no crash, but around a 15% drop for the year. Then fast forward to the latest data point of 2 consecutive more than 20% year gains, that will be in 1997 and 1998. This is the dot-com bubble, correct? So what happened in 1999? Actually, the market rallied even further, another 20% gain. In fact, the gains continued all the way until mid of 2000. So if you think about it, an investor or skeptic at the start of 1999 would be looking stupid for the next 20 months, correct? 20 months, it feels like an eternity already because you hear all the naysayers celebrating the double-digit gains. 20 months of pain if an investor stayed on sideline in 1999 or exited back then. Dot-com really peaked in third quarter 2000 and the real crash was only in 2022. And the reason I'm putting a lot of attention here is because now we feel this AI hype resembling a bit of what happened back in the dot-com days. And to that point, let's answer the first question. Is there always a crash after stocks have ran up? Answer, no. Don't go selling everything because right now stocks are at all-time high. Market is always climbing a wall of worry. When things go up, people hope for better entry. But when there's a pullback, they think that's a market crash. Always remember this saying, market timing never works. It's time in the market. And if you miss the best few days of market, as we can see, the gains are substantially lower. Just missing the best 10 days will have halved the average return. Just missing the best 20 days will have made the returns almost a quarter. Back to our chart on 2 consecutive years of 20+% gain. Do you realize something else from the regions I've boxed up? Let me now put a star to it. Do you now also realize that there are negative years typically after big run-up years, correct? Whether it's immediately in the year after or 2 years after that, there seems to be a decline. For me personally, I think that's just natural. When you go up too fast, you will have a come down period. But does anyone know when the market will crash? No. Does anyone know how severe that downturn will be? Also no. It could be a crash, it could be a small pullback. How long does it last? We also don't know. So to that point, do not ever go shorting the market because the market is at all-time high. On the reverse side of the equation, should you wait until a market crash before you start investing, especially if you are a new investor, you haven't put too much money in yet? The answer again is no. Peter Lynch has this saying, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. For active investors, continue to look for undervalued stocks to add. If you are new to investing, start some today. Dollar cost average gradually because if the market goes up, that's great. You already have some exposure to that. If the market goes down, at least you have a systematic approach in the next few months or next few quarters ahead to continuously buy in a pullback. Don't wait until there's a market downturn because when the market comes down, the news will be negative already, right? It will be uncomfortable to buy by then. So from my experience, it's much better to set a plan in place and then systematically execute it. That's actually what I saw during the COVID crash. Many were waiting for a vaccine to come out first before start investing. That was absolutely nonsense. A simple dollar cost average would have benefited the investor and kept the investor in the market. So if you agree on the message, smash the like button, smash the subscribe as we discuss topics like this to help you become a better investor. Many experts are also suggesting there are good tailwinds for 2025. most of them are bullish right now. Some are putting a target of 7,000 on S&P 500, which actually isn't far-fetched because that's only a 15% gain, a lower amount than the last 2 years of 20+% gain. So some of the tailwinds suggested is the first, US election is over already. Donald Trump is the new president, and he supposedly is very pro-business. His last presidency saw a big bull market. Will it definitely materialize this time round? Maybe it could be. No one knows for sure. The second tailwind is that many feel that Fed is still sounding very dovish. Dovish means supportive, accommodative. Inflation is coming down. The only question becomes the pace. That's why Fed has changed its signal from 5 rate cuts in 2025 to only 1 rate cut. But that also means they have a lot of ammunition left behind, and the potential of rate cut would just be a good tailwind moving forward for 2025. The third big tailwind is that there seems to be a lot of cash still on the sidelines. Mr. Warren Buffett is still keeping a lot of his own Berkshire Hathaway cash in US Treasury bills. Many have followed suit to earn 5%, but if short-term rates continue to come down, then the lure of putting in the markets will be there. Personally, what I believe is don't go chasing the markets right now. Stay invested, but don't go all in. Don't go all in simply means you have to ask yourself, do you still have remaining war chest cash? Do you still have like a buffer that if market corrections come, you can actually deploy? You're not on leverage, you are pretty comfortable to hold if there's a market correction. That's the kind of mindset I'm preparing myself also. For my private clients portfolios, I've kept the equity allocation at only 80%, which means 20% is awaiting opportunities to be deployed in. So if you're keen to look for me for investing and retirement planning advice, look for my links below. I have a very unique perspective in delivering fee-based retirement planning solutions. And not just that, if you'd like to learn a little bit more about investing, join the upcoming FSM Invest Expo 2025. It's going to happen on 18 January Saturday from 10 a.m. to 5 p.m. at Suntec. In this one-day event, you'll hear what's ahead in the semiconductor industry. You'll hear how to invest with this AI cycle. And you'll also hear investing strategies from fellow investors. Is there any admission fee for this event? No, it's absolutely free. So again, it's happening on 18 January, 10 a.m. at Suntec. Look for my links below to get your tickets today. Since you start me right at the very end, let me share with you something interesting that happened after the dot-com bubble. I think the consensus now is that US equity is fair or slightly expensive, but many would avoid calling it a bubble. So if it's fair or slightly expensive, what we can learn from the period of dot-com is that international equities actually did better for the next 10 years versus the S&P 500. 2000 and 2021, S&P 500 came down, international equities came down even more. But then they had a 6 year of outperformance against S&P 500 from 2002 to 2007. I brought up this point to highlight you never know what's happening in the markets. We had for a good few years of tech-led rally. That's why US equities have outperformed. But markets could shine the light on somewhere else in the years ahead. For 2025, diversify well. Hopefully that would benefit you when we do a review at the end of the year. And with that, I'd like to introduce you to some of my previous videos, especially if you're a new investor. These are common mistakes that I'd like to highlight to you to save you some heartaches. With that, I'll sign off from here and see you there. Smash the like button as always because I'm filming this late at night, and I'll see you in the next video. Take care and goodbye.